Hello guys, welcome back to Investing Tutorial. Today, we'll discuss everything from the basics to advanced topics in the stock market, exploring 4 different ways to make money: option trading, intraday trading, swing trading, and long-term investing. Many of you requested a video covering the fundamentals of the entire stock market, so we'll dive into understanding how the financial and stock market world operates. We'll explore the concepts behind these 4 strategies: options trading, intraday trading, swing trading, and long-term investing. Because numerous people have requested insights into the basics of the share market, our aim is to provide videos that give you a comprehensive understanding of the financial and stock market realm. We'll break down the concepts of these 4 strategies and understand the level of risk involved in each. Let's embark on this journey of financial knowledge together. Then the second thing is, what is the minimum amount with which you can start investing or trading? And then how much knowledge is required in each. Exactly what we need to learn, because many people ask me through emails and comments that they want to become a full-time stock market investor or trader. So what do they need to do for that? They will also find their answers in this video, because the majority of people enter the stock market with the mindset that they can quickly make money here. However, when they spend some time in the world of the stock market, they realize that it has different styles. As these 4 styles are quite different from each other, and many times it happens that the knowledge of one style is not applicable in the other. That's why today's video is going to be very important. Be sure to watch it till the end. Because incomplete knowledge in the stock market can be quite dangerous, in today's video, I will explain in a very simple language with examples, so that even if you don't know anything about stock investing and trading, you will learn a lot by the end of this video. So friends, let's start with something that 90% of traders might not know. The riskiest and most profitable strategy in the short term is options trading. Now often, you might have seen screenshots of traders on social media making lakhs of rupees in a single day, or in a video where someone quickly turns a small capital, say a few thousand rupees, into lakhs in a short time. Most probably, they are talking about options trading because it is the riskiest and most volatile trading strategy in the stock market. Many times, situations arise where, for example, you enter an options trade in the morning with a value of 10,000. Within a few hours on the same day, its price can skyrocket to 20,000, 50,000, or even 100,000. In such scenarios, if you trade with a substantial amount, say 100,000, you can witness profits in the lakhs in just one day. However, on the flip side, trading with a larger amount, like 1 million, can also lead to your entire 1 million becoming zero in just a few hours. In fact, sometimes in just a few minutes, and all your money can sink in moments. So this is options trading. Now the question arises, how does this happen, and what's the reason behind it? Let's understand the basics. In the Indian stock market, there are more than 5,000 stocks, but for options trading, we have only 180 stocks and indices. Most people mainly trade in Nifty and Bank Nifty. Now, options are basically a contract. In this, you don't actually buy the stocks of a company. Instead, you buy a related contract. Now you might ask, what is this contract? So a contract can be anything agreed upon between 2 parties. This can also be a condition. For example, suppose you make a bet with your friend that in the next match, Virat Kohli will score more than 50 runs. Your friend says it's difficult, and if Virat Kohli scores less than 50 runs, you win. If you win the bet, your friend will pay you a decided amount, which you both decided in the contract beforehand. Let's say you decide that for every run above 50 that Virat Kohli scores, your friend will pay you 1, and for every run below 50, you will pay him 1,000. So technically, if you look here, the person who is placing the bet that Virat Kohli will score more than 50 runs means you have an unlimited chance to earn money in this bet. Because Virat Kohli can score above 50, 100, 150, 200, or any number of runs. But the person who is betting that Virat will score less than 50 runs, it means your friend doesn't have a chance to win more than 1,000, because Virat can be out for a duck, and the score cannot be less than 0. So options trading works in a similar way. Options buyers and sellers place a bet on a specific stock to reach above or below a target price by a specific date, such as the end of the month or the weekend. Just like you set a target run in the case of 50, similarly, in options, there is a target price known as the strike price. If the stock goes above the target price, the options buyer makes a profit, and if it doesn't, the option seller makes a profit. Now, there are two types of options in this. One is a call option, and the other is a put option. In a call option, if the stock price goes up, the buyer has a chance of unlimited profit. And in a put option, if the stock goes down, the seller has a chance of unlimited profit. Now, this might sound a bit technical, but for now, understand that options trading requires the most expertise. This is because there is the highest chance of both profit and loss in a single trade. To become an expert in this, we will discuss what you need to learn in the upcoming video. Now let's move on to the second category, which is intraday trading. In this, we take a little less risk compared to options, but there is still a considerable risk. The main feature of this is that you actually buy a stock, but with the intention to sell it on the same day. It involves more risk because we use margin. Margin means borrowing money from your broker. For example, if you have 1 million and you get a 5 times margin, which means you can trade with 5 million instead of 1 million. For this, the broker charges a small fee. Now, the benefit here is that if you trade in a stock that increases by just 5 in a single day, and if you had traded without margin, you would have earned a profit only on that 5, which means 1 million would have turned into 5 million. But due to the 5 times margin, you are actually trading with 500,000. So, a 5 increase results in a profit of 25,000 in a day. On the other hand, if it goes the opposite way and you incur a loss, your capital of 500,000 could be wiped out in a single day. Intraday traders do not care about the long-term prospects of a stock or whether it's a penny stock or a good business. They just buy and sell within the same day. So they pick stocks that are highly volatile, meaning they are influenced by a lot of news and are hot. If they make 2,000, 5,000 or 10,000 in a day, it's a good day for them. Until now, we have seen that if a trader is showing profits of lakhs in their demat account, so most probably he's involved in options trading, and perhaps that's his lucky day. Often people, enticed by such screenshots, start foreign trading without any knowledge or research and end up wasting their hard-earned money. They don't even attempt to understand risk management. Therefore, now I am sharing with you some risk management strategies that you can consider before trading. These strategies can significantly reduce your losses. But friends, before that, if you are learning something from this video, quickly hit the like button so that I know, and subscribe to the channel because I will keep bringing such valuable videos on finance and the stock market for you. Now, Value Investor Management also suggested that if you want to trade and try something new, create a separate demat account and don't use more than 10% of your entire capital for trading. Never mix your trading and investing accounts. So, before trading, the first risk management tool is to trade based on risk. In this regard, you can set a maximum risk percentage for each trade. For example, if you decide not to risk more than 2% of your trading capital on a single trade, even if it goes wrong, your loss will be limited to that 2%. This way, you protect yourself from significant losses. Additionally, never risk more than you can afford to lose. Consider your risk tolerance and financial situation before entering a trade. Always keep this in mind, especially in volatile markets. To understand this, let's assume you started trading with 100,000 because that's the amount you have. Now, in your first trade, you risk 500,000. Here, you took a risk of 50% of your capital, which is risky in options trading. Your entire capital could be wiped out in a single day. In such a situation, you might find yourself in a very difficult scenario because to recover a loss of 50%, you need to make a profit of 100%, returning to the original 100,000 capital. If you incur a loss of 90%, you would need to make a profit of 900% just to recover and get back to your 100,000 capital. Therefore, experienced traders mostly focus on managing risk in trading. Ideally, most traders do not take more than a 2% risk in a single trade. For instance, if you start trading with 100,000, risking 200,000 in a trade can help you avoid significant losses. You can set an instruction to limit losses to a specific amount, creating a boundary. Setting up such boundaries ensures that if the market moves in the wrong direction, your order is automatically placed, limiting the loss to a smaller amount. This helps you manage risk effectively with smaller losses. Where you had set a boundary, this stop loss is only used by traders, not long-term investors. Long-term investors, when they see their own stocks in loss and trust the company, might buy more. We'll do a detailed comparison of this in the upcoming video because this video is specifically created for those who often get confused between trading and investing. After this, we have the trailing stop loss. Now, the special thing about this is that its stop loss order keeps increasing with the stock price. For example, if you set a stop loss order at 1,000 and the stock goes from 1 to 500, then back to 900, you've missed a good opportunity to make a profit by selling the stock at 500. This is where the trailing stop loss order comes in. In this order, your stop loss amount keeps increasing, and when the stock falls from the highest amount you've set, such as 1,000 to 990, or whatever amount you've set, the sell order is placed. In other words, if the stock reaches 500, the trailing stop loss order is executed at 490, and you make a good profit. These are all basic features that the majority of traders should know from the beginning. However, many traders, especially new ones, do not even do basic homework or analysis, resulting in continuous losses. Eventually, they give up on the stock market. Therefore, if you are trading, you should always analyze your past trades. Here, you can also use the Angel On mobile app, which is the best app for your investment journey, because it shows you the history and analysis of your past trades, which is a very useful feature. With their My Trade story, you can even see the harsh truth of your trades because they have many features. The first one is the stock score that tells you the score of your trade success, meaning the chances of your success. The second is the strike rate that provides information on winning and losing trades. Then there is the average profit and loss size. And we also get average holding period and profit and loss analytics. This will give you metrics for each set, such as real-life P&L and potential maximum profits or potential maximum losses. All these are very valuable features because almost everyone who trades or invests in the stock market keeps buying and selling without any special analysis. Later, when they incur losses, they don't even analyze how to avoid it in the future. Therefore, you should not make this mistake. If you are trading or investing in the stock market, you can also see your blind spots. By following just a few steps, first download the Angel One app. Then, click on the portfolio icon at the bottom. By clicking there, you need to click on My Trade Story. And then, by clicking on View Analytics, you will get the analysis of all your previous trades. You can check the link in the description below for this app. Now let's move on to our third category, which is swing trading. For this, when you buy shares from your Demat account, the process of buying is completely similar to long-term investing. You can hold those stocks for a week, a month, 2 months, or even 2 years. However, the main difference in swing trading compared to long-term investing is that you primarily read charts, and by reading charts, you identify when to sell after some time. Therefore, it doesn't matter what the company is doing, what the company's management is doing, and what business the company is involved in. In swing trading, the risk is the least compared to the other two options. Because very few stocks will become zero in a single day without any news or announcement, the risk here has become lower compared to the other two options. Therefore, you won't get as much profit here, and that too is available in the long term. Such profits may be seen in a week or a month. Finally, we move on to our fourth category, which is long-term investing. This is a category where people often enter after exploring other trading styles because you cannot make money quickly here. People often find it boring, and to earn money here, you need to invest a significant amount. First, let's discuss the minimum amount you can start investing or trading with. For options, you can start with as little as 2,000 to 5,000. And as I mentioned, if you are lucky, this can increase by 500 times or even become zero. Then comes intraday trading, where you get margin facilities, and you can start trading with a capital as low as 20,000 to 50,000. Because if a stock goes above 2 or 3 in a single day, with a capital of 50,000 and 5 times margin, even if you make a profit at 2, your daily capital requirement would be 5 million or more. Because if your stock goes above 10 in a month, you've earned 1 million on 100,000 invested. So if you earn less than this in an entire month, it will be considered quite low. Therefore, notice here that for trading, you also need a significant capital. You don't have to invest more than 2 to 4 times your capital in one trade. So, suppose you invest 2 million in one trade, which is 4 times your capital. In that case, you need to have a capital of 500,000 to start intraday trading. It is a myth in trading that you can start with a small amount here. You might manage to start, but as soon as you incur losses, your game is over. On the other hand, in long-term investing, when you start here, you can start with 2,000 or 5,000, buying a couple of stocks of a company. However, you won't become a millionaire with a small amount here either. The difference here is that, in the short term, your entire money cannot go to zero, as compared to the other three options. Therefore, even if you start with a small amount, you won't become a millionaire here. The difference here is that in short-term investing, you can't make money quickly, and it takes time. Still, your risk is the least compared to the other three options, so you keep investing more amount here. Typically, people keep investing small amounts in long-term investing throughout their lifetime, which eventually results in significant wealth after several years. So although this option is the most boring, its most significant advantage is that you can benefit from compounding. In the beginning, you might not make much profit, but gradually, in the long term, without any extra effort, you will keep getting increasing profits every year due to the power of compounding. You won't need to put in much effort and time. Now let's understand how much knowledge you need in these four options. In swing trading, the least effort and knowledge are required. It's the easiest trading style. Because here, you need to understand selected chart patterns, moving averages, candlestick patterns, golden crossovers, death crossovers, and a few technical things. With this knowledge, you can do swing trading, and you only need to analyze once or twice a month. So you can even do this on your day off. Next comes intraday trading. For this, you need to learn many indicators such as trend lines, support resistance, RSI, moving averages, and many other advanced chart analysis techniques. You need to learn advanced level chart analysis to do options trading. For options, you need the most knowledge. You need to learn everything, but along with that, you should know how to analyze the option chain. Then, you also need to understand option Greeks like delta, gamma, theta, and vega. Learning these helps to measure your risk. Besides these, there are many other option Greeks that you need to learn. It's not like you can do options trading with very little knowledge here, and you will start making money. This is the reason why there's a written rule in trading, the 90-90-90 rule. 90% of traders lose 90% of their capital in the first 90 days. And this is the thing. SEBI has also informed us through a proper report last year that 90% of traders in India are incurring losses. So, now you have received a very important education that even if you are learning trading, chances of more losses are there at the beginning. You don't need to use more than 2 to 4 times the capital for one trade. If you pay attention to these small things, you will surpass 90% of traders. When it comes to long-term stock investing, you need to put in a medium level of effort because here you don't have to read stock charts, but analyze the business. As Peter Lynch, a popular quote says, "Behind every stock is a business. Find out what it is doing." So when you do this, meaning investing with good research in long-term direct stock investing, I believe investors earn. So, these were the 4 basic ways to earn money from the stock market. In the coming video, we will understand short selling, which Rakesh Jhunjhunwala used to earn good money during the Harshad Mehta scam. If you want me to discuss it in detail, let me know in the comments. Or if you want me to create videos on long-term investing, also let me know in the comments. Today's video, I hope, has taught you something new about the stock market. Share it with your friends and family, and let them know what the actual stock market is. If you haven't subscribed to the channel yet, do it quickly, because I promise to bring valuable videos for you. If you liked the video, hit the like button. Thank you for your valuable time. Goodbye and happy investing. You alone are responsible for your trading decisions. Investments and securities market are subject to market risks. Read all the related documents carefully before investing.